Hey, good afternoon, everybody. This is Chris Robinson, Robin's Ag Marketing with today's post-close grain and livestock comments for November 19th, 2025. Uh, if you don't know what volatility is, you're getting a first-class reintroduction to it. Beans were 35 cents off their high from yesterday's 18-month high. We gave back 35 cents just like that. Um, that's probably the biggest mover there. We did get confirmation of a sale, probably an old sale. The Chinese are up to about a little under 2 million metric tons. That means they've got 10 more million metric tons to go. And so far, it's been crickets um, for new sales. So, did we really rally $1.57 on the promise of, and then only getting 2 million metric tons when we're supposed to get 12? Now, granted, that's the rally from the October low, but you got to think that a big part of this rally and a big part of the reason the funds continued to get long, was uh, trying to get in front of this idea that the Chinese were coming back in force. Did the Chinese buy futures instead of the cash grain? A lot of people seem to think that that's a possibility. We really will know a lot more when we get commitment traders this week. What's really going on? Um, we came into this week with this idea that the funds were short about 70,000 wheat, about 60,000 corn, long about 104,000 beans, short 70,000 meal, and long 15,000 bean oil. That may be a bad position to have right now because they did kick the whole RINs idea 1 to 2 years away. There's a lot more to it, but at the end of the day, I'm not here to write think pieces on what the government's doing. We were looking for some bullish news if they adjusted the biodiesel strategy. For whatever reason, that decision is going to be delayed. That's not bullish for bean oil. Long story short, so if you got long here on this 1 month high, I would be defending against possibly slipping away and going back down and testing the recent 5 month low. That's the risk there. So, um, will we continue to pull back? Typically, when you have a $1.57 range rally, excuse me, which takes 8 weeks, sooner or later we'll have a sizable correction. Today's correction, again, took us down to 1135. The funny thing is, it's funny, not humorous, but funny, odd. Some of you work with me. We had some bean puts on heading into the report at 11:30 or 11:40. The 11:40s, I know in some cases we paid 8 cents for. On Monday night, they traded at 28. Then they were worthless as of yesterday. Today, they're back to worth 10 cents. That is, in a nutshell, is one reason I like using the options because if you need the hedge, if you already bet long the futures, and if you were using futures, why wouldn't you have lifted your hedge when we were screaming higher, right? Like, who wants to be short futures if we're ripping higher? Lo and behold, these puts are doing their job. Now, did anybody roll them up from 11:30 to 11:50? No. But it just goes to show you 11:40s there from from worth about 8 cents to 28 cents to worthless to back to 10 cents. And these all expire Friday. So December is going to be interesting. We do have December options expiration in corn. Not surprising, we settled right around the 430 level. I think that's going to be a big fighting level there to watch as well. If you look at big picture, though, now we're going to look and see, well, how much of the recent rally could we potentially get back? In soybeans, what am I looking at? Well, it's not rocket science. It's just the 750-year-old math retracements that we've watched for a long, long time. You tend to see these percentage retracements over and over again in a lot of markets. So support comes around 1128. That would be a 25% retracement of the $1.57 rally in beans. If we were to, for some reason, really get slammed and go back, the next support is 1104. That's 38%. And then if I don't think we could get there by Friday, but you never know. Halfway back would be 1084. Wouldn't that be something to infuriate people if you watched it go to 1131 and then have it, a severe haircut like that? So I don't know if that's what's going to happen. Even if you've done no hedging at all, there's still a lot of meat on the bone. Again, I'm looking at soybeans in particular from the October low to yesterday's 18-month high, $1.57 rally. Don't sit there and do nothing, and you don't have to spend a whole lot. You could do an option just till Friday if you want to hedge. So take a look at that. If you've got risk, if you're worried about it, get something done. You could do something for a week. You could do something for a month. Um, okay. In the D's corn, we finished down 7 cents, right at 429 and 3/4. I wrote about it this morning in the letter. There's a little over 50,000 contracts there, both puts and calls. If we settled right at 430, that means all those puts and calls go worthless. That's what people don't like about options, right? Or people are going to have the decisions. Do they want to exercise them? Do you want to turn it into futures? So 430 may be a fighting level here until we get through Friday. We'll have to wait and see. Why? Because there are so many options there. A lot of people have risk there. It's going to attract a lot of attention. Chicago wheat down to 9 3/4 at 536 3/4. Kansas City wheat D's down 10 3/4. Again, we had a really good rally in wheat. A lot of it was just fueled by really what I call a courtesy buy of China of our wheat. And we're still in relatively good position if you look at where we were. If I look at East Kansas City, we had a contract low in the middle of October there at 477. We did manage to rally up to 540. So that was a good rally. Even at 515, the last time I checked, 515 is better than 477. So 35, 40 cents. Is that worth anything to you? Maybe, maybe not. But again, we are being driven mostly by the interest in people being long soybeans. And again, with these options expiration, wouldn't be surprised to see more volatility. And anybody that tells you, oh, I knew this was going to happen, or I knew that was going to happen, absolutely completely bananas. What you can do at most is try to capture rallies, try to capture the meat of the move. And for me to sit here and say, hey, the lows in or the highs in, either way, I think that's just disingenuous and worthless, really, to somebody out there who's looking for some guidance. So I come back to what I always say: keep your risk on paper. We're going to have to fight through Friday and see what happens. In the hogs and livestock market, hogs managed to finish the day higher. Looked like a little bit of short cover and rally. We did make a new 4-month low yesterday in these hogs. We bounced a couple pennies off there. We had a low yesterday of 77.5. We finished today at 78.850. So just about $1 higher. Maybe some people stepping in there and trying to buy it against the low that we saw in July at 77.80. If that fails, boy, there's going to be more downside pressure, and it's going to be really interesting to see what the commitment to traders says, because the last time we had one about 6 weeks ago, the funds have been long across the board. It's going to be interesting to see how they're bet especially after the sizable haircut that we've had in both fat cattle and feeder cattle. If you want these levels, if you're curious about what we're looking at, sign up for the letter that goes out every morning. You get a fresh look at it every day. I run the numbers every day. I do the homework nobody wants to do. If I'm looking at if I'm looking at February fat cattle, it sure did look like we were going to go test 212, which 212 is important. Why is that? Well, you take the old September low down at 174. You take the contract high at 250 and change. Lo and behold, 212 is halfway back. This morning's low was just under 215, 214.62. We'll have to see if we can avoid seeing 211, 212 between now and the end of the week. We do have a cattle on feed on Friday, although at this point, I think it's more about money flow. But even if you've done nothing, and if you've been long cattle since last September, you're not obligated to give the rest of it back, right? And for me to sit here, I'm not promising you that, look out, we're going to go back below $2. I'm not promising anybody that. But when you have a rally from 174 to 250, we've been sitting here at this 221 level now for about 2-3 weeks, this 38% retracement. If that was to really fail, this 220 level, 221, we can't get back north of that, then people are going to head for the exits. And that suggests a possibility that we could go down to 212, possibly on an even bigger flush down to the 203 level. 203 is a 62% pullback of that big move. So keep a big picture move. Day to day, it's almost like trying to play catch with an M80 if you're trading cattle. We had another $6 range in fat cattle. feeder cattle, almost another $11 range. And if you're on the wrong side of any of these $11 moves, it gets very, very, very painful. I'm going to switch over real quick to January feeders. January feeders. I'm going to do the quick math for you as well. You know, we started this whole mess back in February around 256. We topped out at 380. And yes, this 317, 318 level, very, very key. It's the halfway back 50% retracement. We did dip as low as 310 and change just 4 days ago. And so we're fighting it out here in a very volatile range between basically 310 and 330. So if every day you're getting involved in cattle, you've got a $20 risk. You better have very, very tight buy stops and sell stops because it's very, very easy to get run over in this market. I'm not saying it's easy. It is a market that lends itself to using options because at least you have your hedge. At least once you pay for it, you know where your floor is, and you can kind of sit back and let the cash market do what it wants to do as it whips around at $20 ranges. Um, you know, today again another $11 trading range. So that's probably the three biggest things I wanted to cover. You know, are the deferred months in the hogs, are they trying to put in some sort of a low here? We'll see. If you look at April has tested 82 cents now 2 days in a row. Again, how we get through Friday is very, very key. On a statistical basis, if you look at the April hog rally, the whole mess started at 75 cents, topped out at 90, just about 95. You know, so we had a $20 rally. We have given back more than 62%. And we did settle basically right at 82.70. That's the 62% retracement of the entire rally. So what I'm saying is we had a $20 rally that took 3 months. And then in the last month, we've given back 60% of it. That's why we hedge. That's why we try and do stuff. If you're a producer, you're always bet long. So your best tool to have to defend revenue are the put options. Okay, it's going to be an interesting rest of the week. If you want to talk to me personally, if you're curious about finding out more about how my program works, how I work, you know, how I make my suggestions, if you're interested in finding out more about, you know, how I approach risk management, if you want to sign up for my letter, take a look at it. If you like it, keep it. If you don't, no harm, no foul. I'm always available to talk about stuff, even if you don't know anything about options. Give me a call. Hopefully I can help you. Have a good rest of the day. This is Chris.